What's up? What's up? What's up? My mind, your money business, folks. I hope you're having a blessed day. The stock market has closed. It's been closed for a couple hours now, but I'm doing my review a little late because my morning started at 3 a.m. But nonetheless, today's stock market, it says stock rally loses steam as S&P 500 Dow slipped from records. Even though that may sound like a negative thing, right? I actually made money today in several different stocks. But let's continue on to read from the experts that that posted this um, article that did not sound like the best thing, right? Um, but had you been invested and not be someone sitting on the sidelines, you would have made money, regardless of what this headline says or the way it makes you feel, but you don't know. All right. So it says US stock lost steam on Wednesday after markets hit all-time highs with the three major gouges closing mixed as investors debated the health of the economy and the chances of another jumbo rate cut. Now, in my opinion, what investors are they talking about? Because this wasn't a worry of mine. I believe the investors that they're talking about are the ones that are on Wall Street, the ones that hold and maintain the bulk of the money that's invested into the stock market. These hedge funds, these billions of dollars, is their opinions that these people are talking about in this article. And the experts that wrote this article goes by the name of Alexandra Canal and Karen Fryer, right? And so it says again, I'm going to read the sentence over again. U.S. stocks lost steam on Wednesday after markets hit all-time highs, with the three major gouges closing mixed as investors debated on the health of the economy and the chances of another jumbo rate cut. I'm an investor, and I'm just thinking about investing my money in good growth stocks. Either way, the Dow Jones Industrial Average reversed earlier gains to close down about 0.7%, while the S&P 500 also slipped into negative territory, declining around 0.2% on the heels of record closes for both indexes. The tech-heavy Nasdaq finished the day just above the flat line, right? The question now becomes whether or not the U.S. economy could find itself in a recession, with concerns fanned by surprisingly weak readings on consumer confidence. The debate centers on whether the Federal Reserve lowered rates by a bigger than usual 0.5%, the 50 basis points that the Feds just gave us on the 18th of September. They're saying it may be too big. In response to a slowing economy and what further malice means for another hoped for deep cut. I will say this. In the news and in places like this, it's filled with a lot of negativity built within it. And this causes regular individuals like myself us to stress ourselves out, especially if you're new to investing and you're reading stuff like this. You're like, you know what? This doesn't sound like a great idea. I'm not investing right now. So I'm just going to stay on the sidelines and not pay too much attention to it. And maybe I'll look into it next month or 2 months. And then when you look into it 2 months, the market may have tripled, right? So the point is to do your research. You have to do your research when you're investing and not take everything that you read so seriously, which makes you feel a certain type of way because it's all psychological. I would call it psychological warfare, right? Um, Reports like this will cause people to get out of the stock market because they're not hedge fund investors. They don't have billions of dollars. They don't have influence and the ability to drive up a stock price or drive it down, like Nvidia, because Nvidia was just $90 at the beginning of August, around the first week of August, August 5th, right? $90, and Nvidia is currently trading for $123.51. So that's $33 that stock has gained in a month and 21 days, right? Total. What if you had pulled your money out when it dropped down to 90 because you thought it was going to continue to go down? And now it's at 123. You lost out on the gains of that stock. So that's why is you have to do your due diligence. You have to invest, understand what you're investing in. I'm in it for the long haul. I would say the average consumer like myself should be in the stock market for a long haul, for the long haul, but that's just my opinion. I'm not a financial advisor. I'm not a professional at this. I am just simply coming online and giving my opinion and my thoughts on the things that I research and read. And I highly suggest that you do the same. Don't just take my word for it. Don't just take Alexandra Canal and Karen Fryer's word for it. Read it, let it soak in, make a decision. And hopefully you will make the right decision for you and your family. Okay, the article goes on to say, because it's not that long. No, it's not that long. It says, oh, and also at the end of this, I'm going to talk about why it is important to invest. It's very important to invest. You should want to have multiple streams of income coming in to your bank account when you do decide to retire at the age of 50, 60, 70, whatever the case may be. You need more money coming in because you're no longer working for your income. So that's why it's important for you to invest. If you're working a 9 to 5, invest your money, set yourself up, create that foundation. So when you stop waking up early in the morning to go check in at someone else's place of work or employment, you can still maintain the same lifestyle. You can have the same monies coming in or more. That's why you need to create a plan. If you can't or don't know how to create a plan for yourself, that's why you go out and you seek the counsel of those that do, a financial advisor. There's some in your area. Just Google it. Use Google. Okay. The article goes on to say, on the data front, new home sales declined in August. Of course it did. Rates were still high in August, following a sharp increase the month prior as ultra-high mortgage rates and lofty prices kept buyers mostly on the sideline. Again, with the rate cuts, it will allow people to borrow money at a cheaper rate to finance these homes because the prices of these homes are not going down. Just like the stock prices, when they're good growth stocks, they're not going to go down anytime soon. They may do a correction. They may go down like Nvidia went down, but they will at some point go back up. And because I'm a long-term investor, when stocks that I've researched and I know to be good, the financial reports that they provide, the quarterly reports come out and they're good, I will continue to invest my money into those things, those stocks like an Nvidia for the long haul until something comes out that tells me, okay, maybe I should pull my money out of the stock because the company's no longer earning money. They're losing money. The CEO has been caught up in some scandal, has to step down, so on and so forth. All right. Says mortgage applications, however, jumped to the highest level since 2022, according to MBA data released before the bell. It's interesting how they said on the data front, new home sales declined. So they started that off talking about homes in a negative way. It declined in August, but then in the next sentence, mortgage applications, however, jumped to the highest level since 2022, according to MBA data release before the bell today, before the market closed on September 25th. Today's, it's the 26th for me. It's Thursday morning here. But it just closed Wednesday evening, Wednesday at 4. Applications went up. Why did they go up? Because interest rates are down 0.5%. People can borrow money at a lower rate. Borrowing money at a lower rate puts more money in the economy and into these stocks. real estate stocks, these mortgage-backed loans. All this stuff is investable, people. Okay, the growth was driven by homeowners seeking to refinance loans as rates drop. See? But the spotlight is firmly on Thursday's second quarter GDP print, okay? And Friday's crucial reading on the PCE index, the inflation gauge favored by the Feds. So you have to be on the lookout for the GDP report that's coming out this week. And that's the gross domestic product report. And you can go to the Bureau of Economic Analysis to read up on that. And then the other report that's coming out, well, the GDP report and the PCE report both are coming out on Friday. And just understand, and by listening to these videos that I'm putting out, there are so many things that can affect the stock market, not just the financials of a company, but also these reports. The PCE report you can also find on the Bureau of Economic Analysis, BEA's website. And that's the personal consumption expenditures, like how much money are people spending. So that can affect the big time, the major investors' input or money that's being invested into the stock market. Now, getting into it, because that's all of the article that I plan to read, and plus I have to get out of here and go to work. Why is it important to invest? Why invest? Having a savings account isn't enough. And I can say that is so true because I remember a family member at one point had retired from work, and then there was some medical issues. And all they were getting is Social Security. There was no money invested, while that individual was working. So all they had was the savings account and Social Security, and it was not enough for that individual to survive off of. They ended up bleeding their savings account dry. Yeah. And what did I hit? Turned on the bright lights. Hope that's not too bright. Let me see. There we go. Yeah. So either way, they ended up bleeding their savings account dry. That's why having a savings account is not enough when it comes to investing and having, unless you have millions of dollars in your savings account, which I wouldn't advise because banks are only have to pay you $250,000. Like say if something happens to the bank, you're only insured up to $250,000. So it wouldn't be smart to have millions of dollars in the bank, right? But savings account is important, but it's only part of the story. Smart savers start by building sufficient emergency savings with a savings account and through investment in a money market account. But after building 3 to 6 months of easy to access savings, investing is the financial markets offer. In the financial markets offers many potential advantages. Like there's no need to have, millions of dollars and hundreds of thousands of dollars in your savings account. Build up your emergency fund of 3 to 6 months of your living expenses. How much is your rent, your mortgage, your utilities, car payment, car insurance, utilities, phone? How much do you spend on average going out to eat, to the movies? How much do you spend on average going to the going out of the country, going on trip, family vacations, so on and so whatever. Well, let's just say your monthly expenses, and maybe not family vacations, but your monthly expenses, right? You should have 3 to 6 months of that saved up that you do not touch. And then you should also have a budget set up for your monthly expenses, right? And so anything that's left over, that's what you should then utilize to invest that money, because you already have your 3 to 6 months of emergency funds sitting off to the side. Say the hot water heater goes out in your home You may be able to claim some of it against your homeowner's insurance, and you then may have to pay out $1,700. Take that $1,700 from your emergency savings. That's why it's there. You have that money. You don't have to charge it to your credit card and continue to build up that debt. You have that money in your savings account, your emergency savings. You pull out that $1,700. You pay off the remaining balance of that hot water heater. And then because you just removed $1,700, now you can start factoring in building back that $1,700 that was taken out for the emergency. So now you can include that into your monthly budget. Now you're saying, okay, instead of me investing $2,000 a month, because I normally had that left over to invest into the stock market, now I'm only going to invest $1,500 because now I'm going to put $500 back into my emergency savings account until I build up that $1,700 again. And then after that $1,700 has been replaced, now you go back to investing your $2,000 a month. That's how you do it, right? And then again, if you do plan to do, family vacations, you adjust your budget accordingly. Okay, why is investing important? Investing is an effective way to put your money to work and potentially build wealth. Smart investing may allow your money to outpace inflation and increase in value. So if the price of things are going up because of inflation and you're leaving your money in the bank, right? All of your money, not more than just 3 to 6 months of your money in the bank. And you're getting like 0.1% on that savings account, and the cost of goods and services are going up, you're actually losing money. You should have your money parked in a place where it can earn more money. Maybe when prices are going up, interest rates are up like they were before, now you can invest your money into a high yield savings account, which may offer you 4 to 5%, right? So, you have to be aware where you should have your money during specific times and how much of that money should be there. All right. Because a lot of us have never heard of a 3 to 6 month savings account. I learned of it when I listened to Dave Ramsey when I became debt free, because before then I had never heard of that concept before in my life. Okay. We learn about a lot of things in school, but one thing we don't learn about is investing and how to stay out of debt. Because we're bombarded with like commercials and things and other places that we should want to go, which requires the spending of money. And the most time, the people that are spending that money don't really have it to spend, so they charge it to their credit cards, right? And you need to understand the people that are pushing out these products for us to buy are the owners of those products who have the money, who can easily take those trips, who can get on a private jet, who probably owns a private jet, who owns real estate. They own all of this stuff. Majority of their money is in the stock market, making them more money because you as the consumer is spending your money on their product. And by spending money on their products, it continues to make them more and more money, wealthier and wealthier. However, you too can join in, right? You can join in. You can also buy stocks in those investments. And as consumers, to include yourself, buy those products, which is a good product, making the company more money. You too can make money in your sleep, right? It works out for everybody. The power of compounding. Compounding occurs when an investment generates earnings or dividends, which are reinvested. These earnings or dividends then generate their own earnings. So in other words, compounding is when your investment generate earnings from previous earnings. So it's like the money, the interest that's made on your stocks is placed back into your portfolio and into your stock account. And so now as more and more money continues to generate and more money is being placed back into your account, it continues to go up. And on yesterday, I went to a future value calculator, which you can do too, and you can punch in numbers. Like if you invest, if you put in $10,000 and then you start to put in $10,000 a year over a 10-year period. And let's say you invest in an S&P 500, which on average has brought back 10.628% over the last 100 years. That's correct. Over the last 100 years, the S&P 500, which consists of the 500 largest companies in the United States, has brought in 10%, a little over 10%. So what if you had been investing for over 15, 20 years, 30 years, right? Because you started at the age of 24 when you first got out of college and you started investing 10% of your or 15% of your money, and then over time you saw how you were making more and more money, and as you moved up in companies or you moved up, uh, in your corporation or another corporation, or you created your own business and you created a business account. Either way, and investing into the S&P 500, you would have made over 10% on your money. And that is a lot of money. So when you go to the future values calculator, you can punch in that information and you will see how compounding interest works. Okay, if you invest in a dividend paying stock, say like an AT&T, I think Starbucks is a dividend paying stock. There are REITs, real estate investment trusts, that you can invest in that also pays dividends. NVIDIA pays a very small dividend. I believe Johnson and Johnson pays a dividend. Coca-Cola pays a dividend. General Electric pays a dividend. Ford Motors pay a dividend. So what these companies do with these dividend payments, they take the profits that their company is making, and instead of paying that money to the government through dividends, they've been able to find a way to pay its shareholders. When you own a stock, when you own one share of Ford, you are a shareholder in that company. So that may explain why you have nothing but Ford Motors. You're buying a product that you own. You own shares within that company. But either way, these companies pay you for simply owning them. And a lot of people do not know that. I owned a REIT that was paying me, the last payment that I got was $1,370. You have some dividend paying companies that pay you monthly, then you have some that pay you quarterly. The real estate investment trust that I had, REIT, a real estate stock, was paying me every 3 months. So the more and more shares you own, the more dividends you will receive, right? Again, if you invest in a dividend paying stock, for example, you might consider taking advantage of the potential power of compounding by choosing to reinvest the dividends. And that's what I had on my stockbroker's account, my online stockbroker's account. I always had, like when you buy this stock, I always clicked on reinvest dividends. So, because if not, what they would do is when the dividends are paid out, it will just go to your account and just sit there. And you wonder, why is that money sitting there? Because you didn't select to reinvest it. So just select to reinvest. So whenever they pay out the dividends every month or quarter, it just goes back into your account for that particular stock, buying you more of the stock. And as you buy more stocks and the price continues to go up, the more money you continue to make. Okay, to help increase the potential benefits of compounding, start investing as soon as possible and automatically reinvest your dividends in other distributions. That's exactly what I just said. When you invest into, or when you buy dividend paying stocks, pay attention to when you're purchasing the stocks. It will show, there will be a line where it says dividends. Click to reinvest. So reinvest those dividends. Because this is what a lot of people do that you probably don't know about. They live off of their dividends. Say if they've been putting thousands and thousands of dollars in Coca-Cola, and now they own thousands of shares of Coca-Cola. And again, all of this information can be found on the internet, right? So let me go to Coca-Cola dividends. Coca-Cola now pays pretty much 49 cents per share, right? In dividends. So let's say you, over time, you've been investing your money and you have now 15,000 shares of Coca-Cola, right? Say you've been investing, or your father, mother, or your grandfather, either way, someone started investing for you since you were 10, you continue to invest it. Now you're age 65. You have other stocks, but you also have 15,000 shares of Coca-Cola, right? So 15,000 shares of Coca-Cola times 49 cents. That's $7,350. $7,350. And I don't, how often are there dividend? I don't want to look, I'm not going to do too much research because I have to get out of here soon. But let's say Coca-Cola pays that out each quarter. So each quarter, you're getting $7,350, right? And, hold on. I'm about to show you, I'll tell you because I'm not showing you anything. I'm using my calculator on my computer. And then that's 7,350 times 4. That's $29,000 a year just from that one stock. And that may not be your only dividend paying stock, right? So $29,400, and let's say times 4, that's $2,400 or $2,450 a month that you could gain or you could live off of. But because it's quarterly, the $7,350 will be paid every 3 months. But now, because you're retired and you want to live off of your retirement, right? Instead of having that money reinvested, you just have that money sent to your checking account. You no longer have to reinvest the money because now you're retired and you're utilizing the money to live off of. And this is what people do. Some people live off of their dividends. Yes, you have some good steady dividend paying stocks that does not change as much. And I believe Coca-Cola is one of them. How much is Coca-Cola stock now? Oh, it's $71. For a very long time, it was like 55, 60. Now it's $71 a share. Not bad, Coca-Cola. Okay, the risk return trade-off. Different investments offer varying levels of potential return and market risk, right? Risk is an investment chance of producing a lower than expected return or even losing value, which is true. That's why I do not advise, my personal opinion, I'm not a financial advisor, so you don't have to listen to me. I'm just giving you my opinion. It's good to have a very diversified portfolio. Even though I was talking about Coca-Cola, let's say you have Coca-Cola. Not all of your money that's being invested each month should be going to Coca-Cola. You should diversify your portfolio. Diversify your portfolio, right? You can have Coca-Cola. You can also have, another good growth stock. Let's just say NVIDIA, right? Because NVIDIA year to date has brought in 140%, returns on its money. But let's just say it's NVIDIA. And then also, if you're managing your own portfolio, you can switch things around. You can sell your NVIDIA stock. You can sell your Coca-Cola stock and purchase something else. But either way, diversify your portfolio, people. Like I talked about earlier, the S&P 500, it tends to bring back over the last 100 years, 10%. Right now, the S&P 500 is at about 20%. If I'm not mistaken, 19 or 20%. Let me see right quick. So I'm going to go to my buddy, SPLG, which went down today 15 cents, right? It's now selling for $67.04. It's an S&P 500 ETF, exchange traded fund. Year to date, it has returned 21.41%. That's why I said over the 100 years, the average has been 10%, because some years it's 10%, some years it's 7%, some years it's 8%, other years it's 12%, another year could be 15, another year could be 19, 20. Right now it's on track. It's at 21.41% year to date from January up until September 25th of 2024, 21%. You can also invest in something like FTEC, like I do. It's an information technology exchange traded fund, which consists of about almost 300 information technology companies are all bundled in this one exchange traded fund, right? Um, Year to date returns on this ETF is 20.75%. Yes. NVIDIA, like I said, you can go do your research. You can Google this. You don't have to believe what I am telling you. But year to date returns on NVIDIA is 149% year to date. So if you hit 149%, that's a lot. I think Tesla may be down. What is Tesla's year to date return? But I believe Tesla is eventually. Oh well, they're up 3%. Because they have gone up. They went up today by $2.75. So Tesla year to date is 3.44%. Not bad. Not bad at all. What did FTEC? FTEC gained 32 cents today, which isn't bad. It's currently being sold at $173.04. Apple. Apple went down $1 today, and their year-to-date return is 17.58%. Those are good returns, people. So having all of your money in the bank will not bring you these types of returns. Not even having your money in a high yield savings account will bring you these type of returns. But either way, that is the risk of investing into something that may produce lower than expected returns. But again, having your money diversified, like the stocks and the ETFs that I mentioned, can save you. Also, there's one particular stock from Vanguard, VTSAX, the total stock market index fund, is down 40 cents today. It's being sold for $137.24 a share, which is great. But this index fund covers the whole entire stock market. It has the top companies that are in the S&P 500. It has large cap companies like in NVIDIA, Microsoft, Amazon, Tesla. It has mid cap companies, the best mid cap companies. It has the best small cap companies, and it also has some micro companies within it. It has there are over 3,600 companies bundled in this index. So like what happened with Enron back in the day, when that one company goes under, or say Apple goes under, you won't lose all of your money because all of your money is not invested in Apple when you invest in these exchange traded funds or the S&P 500 or VTSAX, the total stock market, because when that one company goes under, you have companies that are still making money. So you will continue to make money. And the managers of these funds, and then here also, you don't have to be the expert at trying to pick the perfect stock. You can invest in an S&P 500 or Vanguard's total market index fund, where the managers of those funds, they are the experts. They will manage the fund for you. If there's a company that's not producing, that fund manager will remove that company and replace it with a company that is producing at a level to make you money, because their job is to make you money, not make you lose money. Because when you're losing money in these funds, you will more than likely pull your money out of them. And when you pull your money out of them, that company like Vanguard would no longer make money. But either way, I think you get what I'm saying. And I have to hurry up. Okay, return is the amount of money you earn on the assets you've invested, or the investment's overall increase in value. Again, when you invest in stocks, you're investing into assets. And if they're good assets, that means they are appreciating, they're going up in value. But oftentimes we basic consumers, the 90 percenters, the 90% of us, right, who go to school, try to get good grades, who join the military like myself, who go off to college, even like myself, who continue to work a 9 to 5, we do not learn how to utilize our money and buy assets. I never really thought about assets until I started listening to Dave Ramsey. And a car is a depreciating asset. Your clothes that you buy is a depreciating asset. You know, if you bought a house and you live in that home, the fact that you're living in that home, it's not really an asset. It's great that you own your home. I'm not saying that. Pay it off as soon as possible. But it becomes an asset when you use it to generate income. You know, that's an asset. Um, you know, owning other real estate like rental property, Airbnbs, it's an asset because it's making you money. Stocks, as they increase in value, pay out dividends. It's an asset. You make money in your sleep. You don't have to work for it. You're making your money work for you because of your budgeting. You're telling your money where to go and do what it does to make you money, and you don't have to do anything for it. So therefore, when you decide to retire, you may retire at the age of 40 or 50. Now, you know, the money that you've generated and placed in those assets are paying you enough money to keep you from having to go back to work. Now, those things that you purchased, those assets you purchased, are now maintaining your lifestyle. So investing in stocks, for example, has the potential to provide higher returns. In contrast, investing in a money market or savings account likely won't offer the same return potential, but it's considered less risky than investing in stocks. It's less risky, and people rather park their money in a savings account because they fear investing. Like reading that article that I was talking about, the language that it puts in it strikes fear. It does that on purpose. The stock market was created for the rich, by the rich, to keep them rich. It wasn't created for the average person to get into. That's why it's not taught in schools. You're taught everything else but this. You know, money's not important. It's not the root of all evil either. I mean, money is just one aspect of life, but you need it. You need it to provide a roof over your head. You need it in order to purchase the things that you need, like water and clothes. You need it. It's very important. So why aren't we taught on how to maximize it? It's done for a reason, right? That's why a lot of us are working till the age of 75 and 80 because we don't have enough money. And then we give other things outside of our own specific situation as the reason why we don't have what we have. No, you don't have what you have because you never put a plan in place because you just didn't know any better. All right. Okay. And so the last bit of this, it says the amount of risk you carry depends on your appetite or tolerance for risk. Only you can decide how much risk you're willing to take for the potential of higher returns. Invest only money that you can afford to lose because investing is risky. But I just told you, and you can Google this yourself, the average return on an S&P 500 investment over the last 100 years. History continues to repeat itself. It can be a good thing if you're choosing to tap into the goodness and figure out how you can get some of that goodness. Or if you're only thinking about the negative parts of history, then expect your life to go into that negative direction because you go where your thoughts go. You need to understand that your thoughts precede you. If you're thinking about the worst and always worrying about something, then that should explain to you why you're always in those types of situations, right? But if you're thinking more positively, you're more open-minded, you're trying to do better, you weigh your pros and your cons, you're not just reactionary, then things will more than likely work out for you, is my opinion. Yeah. And that's what's worked for me. I think it'll work for you too. But you have to make that decision. Right? But if you're seeking to outpace inflation, taking on some risk may be necessary. An increase in risk may provide more potential for your money to grow. And that is the end. You have to take the risk. The risk is you figuring out how to invest. And it's only a risk because this is not something that we're taught in schools. This is not something that we're taught in the educational system. But also, you know, their history has shown us how some companies like Enron, because of corruption, things can go under, or say a company is no longer producing like it should or was, right? Think about Blockbuster. Those of you that are old enough to remember Blockbuster, because of online, movies or the creation of places like Netflix, because they weren't prepared for the changes that were coming. They went out of business. I remember Hollywood videos where you would go in and purchase, like when I was a kid, they had the VHS tapes, and then they started doing the DVDs. You could go into these places and rent them, but now you don't have to do that. Now everything is online. So the people that did not keep up with, or those companies that did not keep up or invest in the changes that were coming, they got left by the wayside. Those companies went under. So say if you had all your money invested into those places back then, you lost all your money. That's why it's good to invest your money, have a diversified portfolio. But that's just an example. So just think about it. But I have to end this video because I got to get out of here and get to work. So you guys take care, peace, and have a blessed day.